Welcome back. This is a breaking news podcast. We don't do these very often. We're having back one of so far this year's favorite co-hosts, Mr. Keith Jensen. And what's this breaking news all about? It's all about Fannie Mae and Freddie Mac. Julie and I have been talking on and off about the release of Fannie Mae, Freddie Mac from conservatorship for going on the podcast 4 or 5 years. And the reality of it is that frankly, I underestimated the importance of it coming out of conservatorship until Keith educated me. And so what is about to happen and what is imminent at this point is that it is going to be released. And what Keith and I are going to do is we're going to pick up on the conversation that we started earlier, probably about a month ago, that was, one of the most downloaded podcasts we've had probably in the last 4 or 5 months. And we're going to pick up right where we left off, because before there was a little, not uncertainty necessarily, but it wasn't a foregone, even a foregone conclusion. It was that it was going to be released, but it certainly wasn't actually, I'd say, as far along the path as it is now. So Keith, without me rambling any longer, welcome back to the podcast.
Thanks for having me back. Great to be here.
Yep. So look, I'm going to toss the ball to you, my friend. You pick it up right where we left off. Obviously, a lot of, the ball's been moved down the field quite a bit. It's this close to the end zone. Off to you.
Bill Pulte was confirmed 2 days ago to be the new FHFA director. And in a tweet within hours of his confirmation, I don't have it in front of me, but in substance, it said this: under President Trump's leadership of the home market, he will utilize Fannie and Freddie and unleash them in a safe and sound manner to bring the opportunity of the American dream to, of course, millions who otherwise don't have it, clearly implying as a result of the conservatorship. He didn't say release and recap it in that tweet, but he came tantalizingly close to saying precisely that. And I don't know what else he could have meant by that tweet.
Well, it was the unofficial official release. I mean, because there was a series of tweets, right? It was 4 little different tweets. And one of them also was big news coming, I think, or big announcement coming. And then for the first time, and I did research this using Grok, AI, he used the term make housing great again. And I hadn't found that anywhere else. And I asked Grok to research it, do a deep research on it. And that phrase wasn't used again. So it seems that Mr. Pulte has tipped the hat as to what the program is actually going to be called. But we can talk about that maybe a little bit further in the podcast.
That history. So in the 6 swing states, which of course we followed day in day out for months on end, all of us did for so many reasons. There was polls in those particular states, and affordable housing was a more important economic issue to swing voters in those swing states than things including good jobs, good retirement, and the price often of food. So that just unsurprisingly represents the fact that we remain in a near low all-time unaffordable housing scenario, and making housing great again is precisely what President Trump has the power to do with a recap and release.
There's a lot of confusion amongst non-housing people about the clearest path forward for their essentially to make housing great again. The obvious answer is a hell of a lot of new construction, and a hell of a lot of new construction aided by a lot new financial products, mortgages and whatnot, which brings us right to the release of Fannie and Freddie. So I'll say it so you don't have to. And essentially the announcement from Pulte, or what he said in the tweets, was confirming that the conservatorship of Fannie and Freddie are over. And we talked about the history of this in our last podcast, and we're not going to rehash that because there's a lot of new ground to cover. Really what we're going to be focusing on today, listeners, is what Keith is expecting to happen next, maybe hypothetical timeframes and things like that. Why does this matter to you, listener, viewer, being that you're in the real estate industry? Because this was going to open the floodgate for new mortgage products. This could hypothetically not raise interest rates, lower interest rates. And Keith hopefully is going to talk about that again, though we did drill down on that a lot in the first show. We're going to see all kinds of new, very creative and dynamic mortgage products are going to come to market. And this is something that, frankly, I learned from Keith in the last podcast, is that the cost of obtaining the cost of a mortgage, not just because of interest rates, but because of PMI and other built-in government costs in obtaining that mortgage, those could actually be eliminated or be reduced greatly. So Keith, without giving you too many more plates to spin in your mind, let's pick it up where we left off, and let's talk about what happens next.
So my crystal ball is no better in terms of timing than it was last time. That in mind, if you and your listeners would like to hear, I'm happy to provide a discussion of the structure of the recap and release. And there's 2 really important things about it. One is, what will the capital retention rate be upon recap and release? That is, how much claims paying assets, if you will, or equity capital, which they are presently at $160 billion combined, need Fannie and Freddie retain as a function to keep them safe and sound against their book of business, roughly $7.5 trillion. So that's a key issue. And another key issue that pertains to this structure, we touched on it last time, but perhaps we go into it deeper this time, is the central question for Treasury and FHFA, namely whether Treasury writes off its senior preferred shares or whether it converts those senior preferred shares. So I'm happy to do either one first.
Well, we should throw in a disclaimer. Obviously, there's an investment opportunity with all of this, and Julie and I are invested with Keith's fund, which is Keith. Why don't you just tell them the name of your fund in case they want to find you?
So I run Convex Venture Management, and it has a fund which is long Fannie and Freddie, and I'm delighted to have Tim and Julie as some of my investors.
So certainly not your largest investors, but yes, you're more than welcome to our poultry investment. All right, so let's talk about that. You talked about essentially what's going to happen with the senior preferreds, I think you said. So let's hear it.
So knowing that you'd want to discuss this, I've come up with a list which perhaps not surprisingly is a top 10 list, literally, of why it is better for Treasury to write off its senior preferred shares than convert them. First, let's define what that means. Okay, so as a function of the 16-year conservatorship, Treasury has acquired what's now 290 billion, almost $300 billion of senior preferred shares. As mentioned last time, they've profited $110 billion of that about 300 billion. Let's go a step further down the rabbit hole. There's also what's called a liquidation preference that's owned by Treasury. And even though Treasury stopped getting the profits, 100% of them, that is, in 2019 that we discussed last time, between 2012 and 2019, and that's when they capped off, if you will, at about $300 billion of senior preferred shares. Their liquidation preference continues to rise as ironically, as Fannie and Freddie continue to make profits. Every $1 billion of additional profit now retained by Fannie and Freddie increases that liquidation preference of Treasury that it owns. It's about, as I mentioned, about 340 billion. It's a non important number because it's not a real number. It's not a real asset that the Treasury can monetize, the liquidation preference, that is. So it either Treasury, it writes off its senior preferred shares, and we discussed last time they've already been paid 110 billion, as just mentioned. They can get paid a second time by converting, but they will get paid a second or third time by exercising their penny warrants, 79.9% in the common. So that's the question, and here's 10 reasons why the Treasury should elect to do the former, write off its senior preferred shares as opposed to convert them. Go ahead.
No. I just want to make sure. So that we're getting into, some very specific information. Let's be more specific why they should care about what you're about to say. So what difference is, it's huge.
Because doing it this way, each of my 10 points, many of them will point out why it's in creditworthy home buyers' best interest it works this way. It's why it's better for the economy this way. It's why it's better for Treasury this way, to do it this way, the write-off, not the conversion. One, if they convert, they will likely prevent this administration from getting the recap and release done. Why? One or more federal judges, in my legal view, I'm a 34-year attorney and I've been following this situation for years. One federal judge or more would likely enter an injunction preventing the Treasury from converting on claims that it's a Fifth Amendment taking without compensation. What are they taking? They're taking the now couple billion-dollar value of the common shares and decimating them by the dilutive effect of their conversion. So I'll come back and explain that more as we go through. Two, no investor will buy common stock in a primary, an IPO, or a secondary stock offering when the value is getting decimated by this conversion. That's just not, and many of these things, and I'll point out three other people I rely on, or at least I look to, and they happen to agree with me on these points. One is Jim Milstein, the former chief restructuring officer of the United States. for the Treasury. In fact, between 2009 and 2011, he restructured AIG by way of example, and he helped my partner, Ricky Rizzo, restructure a lot of the debt in Puerto Rico. That's one agreement. Two is Tim Howard, the former CFO of Fannie Mae, and he's got a blog post on this, a very well done one. And three is Bill Ackman, of course, the founder of Pershing Square. So those three gentlemen agree with our assessment and the next one is that it's actually better for Treasury. They'll wind up with more value if they write off their about $300 billion of senior preferred shares and get rid of that liquidation preference than if they convert. And because they'd be decimating the price of the common. And well, we'll get to more reasons. I've already pointed out they made $110 billion in profit. That's number four. That I've already pointed out that the $340 billion liquidation preference is not real. That's number three. Number five is the government already makes a 10 bips profit. That's a 0.1% profit off each the face value of each mortgage issued. So Fannie and Freddie get 55 bips of the average mortgage, plus the 10 the government gets. They passed that in like 2011, 2012, and unsurprisingly, they've extended it. So what does that amount to, 10 bips? It amounts to, if you, for ease of math, let's call it an $8 trillion book of business. That's about $4 billion for each 5 bips, 10 bips. They make about $8 billion a year already by law to pay for tax cuts. That's number six is it decimates the value of the common. Number seven, it adds $7.5 trillion to the American debt, about $34 trillion right now. An unneeded additor to our debt because they make effectively Fannie and Freddie are the most profitable insurance company in the world. They make 90% roughly of their profits off guarantee or G fees, which, as just stated, are about 55 bips of every mortgage. They should be the sole insurer other than a continued agreed government backstop of that book of business. Number eight, it impairs the institutional and Main Street memory further from what already occurred to them. As discussed last time, for 7 years, 100% of their profits went to the Treasury, and only in 2019, when Calabria reversed it and Mnuchin, have the profits been retained by Fannie and Freddie. They need to get right with Main Street and Wall Street again. They need to get right with them by showing them that they're good faith partners. They're already going to own 80%, the Treasury is, they're already going to own 80% of the released Fannie and Freddie. No need to be punitive in the process by the conversion. 9, it's hypocritical. Why? Because they were getting $8 billion a year from their 10 bips. They got all the profits they got 10% of the profits for the first 4 years. They got 100% of the profits for another 7 years. And they've already made $110 billion in profit. They don't need to incorrectly try to make more by the conversion. And 10 is where I started with number 1. It is a taking. It's a Fifth Amendment unconstitutional taking because it literally deprives value of the owners of the common shares of that value. And those owners include banks who were sold these shares, certainly the junior preferred shares, as pristine collateral upon which they could lend, and moms and pops all over our country making good investments, and index funds before the conservatorship widely held Fannie and Freddie securities in them. Nearly all the big index funds, which are no longer allowed to hold them.
Let me drop this in because we're talking to real estate people. The Fifth Amendment, everyone knows it from watching Law and Order. The Fifth Amendment is where you're the attorney, where you're not. It protects you from saying anything that might actually work. What's the legal term here, Mr. Attorney? That's part of it. The Fifth Amendment has two aspects to it, doesn't it? One is the effectively eminent domain, right?
A taking without compensation is a simple definition of a Fifth Amendment violation, which this would be. And let me make one more point. That these lawsuits that I pointed out in number 1 and for different reasons in number 10 of my list, they would put something in the litigation for the first time that has not been there before. The 2021 Collins versus Mnuchin case did not have any issue before the US Supreme Court, which questioned the underlying propriety of the conservatorship, just the 2012 net worth sweep. This taking would put, in my view, the original conservatorship in question. Why? Because the authority for the taking is the original 2008 preferred stock purchase agreement. So the Trump administration, if they were to take this punitive view and measure against the taxpayers opposed by Milstein, Howard, Ackman and me and my partners would literally be teeing up for litigation something that has not been tested yet, whether they originally had the authority to put them in the conservatorship to begin with. And if you went back and looked at our prior conversation, I laid out why there's really strong arguments that they did not need to be put in conservatorship in 2008.
So from an equity perspective, and I know this is just purely a couple guys just talking on a Zoom, but from an equity perspective, Bill Ackman, I believe, said that if the warrants are exercised, which is what we're talking about, that the value would be hypothetically around $28 a share for FNMA. And I've heard people speculating that if they're not exercised, the value per share is hypothetically around 150 a share based on essentially comparables of similar companies, if there is such a thing. Is that your understanding, or is that too much conjecture for you?
I'm not going to get into what our forecasts are versus Bill Ackman's, but I will say this. Bill Ackman hit the nail on the head when he said the more dilution that occurs, which would occur with the conversion, the less valuable the government's remaining shares are. So it's an 11th reason, or a related one to the 10 I addressed, not to do this. We also agree with Ackman as to where the capital retention rate should be. Maybe we should go there next.
Okay, sure. Let's go for it.
So
First of all, let's make sure we explain to them what that means. The capital retention rate is.
So a standard capital retention rate for a bank is about 4% of assets it holds versus loans it makes. So Mark Calabria, Cato Institute, Trump appointed FHFA director who did not return to that role, but he was just appointed to a different role in this administration. Took the position that they needed bank-like retention rates. They're not banks. They don't borrow short and lend long like banks do, and they don't have deposit flight risk like we saw recently, and starting in March 2023 mid-level banking crisis, deposit flight risk. So, and they also have a completely different business models as a result of that. And they have what Bill Ackman correctly described as a fortress-like balance sheet, $160 billion of equity capital. Let's define that, and then I'll set up what that discussion for the capital retention rate should be in the IPO. So what stands between the taxpayer, heaven forbid, ever needing to do another taxpayer bailout, which we think is so statistically low, it's hard to measure that risk, and that potentially happening. So of that $7.5 trillion book of MBS business, there's as mentioned, a 52% loan to value ratio weighted average. So hence, roughly the $3.75 trillion of equity stands beneath the taxpayer and in another crisis, plus $160 billion of equity capital. And $160 billion of equity capital, really close to where they are right now, is 2.1% of 7.5 trillion. Ackman proposes a 2.5% capital retention rate on a release. If that were to occur today, an IPO, which obviously it can't, but to put it in a frame of reference, that'd be 187 billion. The delta is 27 billion. They made 28.9 billion collectively, the GSEs last year, so easily doable. If you were to use what we've always believed is an unnecessary, needlessly high bank-like capital retention rate, like the framework put into place by Director Calabria when he was the FHFA director, that would, and those are numbers, if you start Googling, you'll see in some articles that require over $300 billion of retained capital to release them. And it's simply not needed, especially when 2009 to date, default rates have been far less than 1%.
Well, so where does this go? So you're saying right now, as the rules are set, there has to be essentially the Fannie Mae, let's say, has to have more savings. That's essentially what we're talking about, rainy day fund. And you're suggesting that the number was originally set too high because it was set as if it were a bank. And it's not really a bank, it's an insurance company. That's what these things in essence are. You made that argument. I think it's very clear. So you're suggesting that what will happen is that the powers that be now will effectively say there's enough money saved, and that's we don't need to worry about that anymore. We're good to go.
Here's the answer. The administration might, and I won't get into the legal analysis of how it needs to need to occur, but they could arguably sign an executive order and set the capital retention rate. Or they might choose to do a notice of proposed rulemaking and provide notice to the industry and allow comment. And then after that period for usually 90 days for those comments ends, then they could adjust the capital retention rate, or what's called the enterprise regulatory capital framework that's presently in place, which is effectively decides what that percent is. And so whether they do it the quicker way by executive order or the notice of proposed rulemaking way, it's certainly within the administration power, especially with the recent executive order, that the executive branch has taken significantly more control over all agencies, including the FHFA. They control what that capital retention rate will be for IPO. And the lower it is, the more valuable the government stake is. Another issue that's worth discussing is the Treasury's write-off, and there's been some statements by people who contribute to the area that the Treasury does not have the capacity to write it off legally. I'd be happy to discuss that.
I am very curious about that, actually. I was reading about that the other day.
So Mark Calabria, in his book, Shelter for the Storm, he wrote that when he and Steve Mnuchin of Treasury were negotiating over the recap release, Treasury took the position that they couldn't write off the senior preferred shares because think of it as an asset. And in a vacuum, I agree with that proposition. If the Treasury, in other words, the Treasury can't give up something for nothing. No question that's legally correct. But here they're not, for reasons that the chief restructuring officer of the United States of America, Jim Milstein, of the Treasury, agrees with, Bill Ackman agrees with, Tim Howard agrees with, we agree with. Treasury's value will be greater if they take this move than not. So it's not giving away for something. It's just giving away something for nothing. It's giving away something to get something much larger in return. That's number one. Number two is there's still lawsuits pending that need to be settled. And a way to do this is to wrap the recap release into a lawsuit settlement. And of course, when you're settling a lawsuit with claims against Fannie and Freddie and still some against Treasury, well, that release provides a legal mechanism for the Treasury to overcome, according to Mark Calabria, some of their stated views that they didn't have the legal capacity to take this act, which I'm confident for those two reasons they do.
So you weren't saying that the last time I had you on. You weren't talking about the fact that you thought the warrants might not be exercised. So is this it, or maybe I wasn't listening?
So no. So what I was just addressing is why Treasury has the legal authority to write off their senior preferred shares. In any scenario, they will still exercise their warrants, their penny warrants in the 79.9% of the common. And Bill Ackman, not unreasonably, estimates the value of that exercise as penny warrants to be north of 300 billion. Our models put a little lower, but a conservative statement I'll make is President Trump, if and when, hopefully soon, does this deal, it will be his biggest deal ever. And he's, as we know, wrote The Art of the Deal. He will get at least $200 billion of new value from the exercise of those penny warrants. And he'll do that without a vote, without going through Ways and Means Committee, without legislation. Full stop. And he will get to decide what to do with that money. He could use it to help build houses. He could use it as a pay for to extend his tax credits. He could use it to make the largest down payment down on the deficit ever in United States history. Or he could do a combination of those three things. Um, and as we discussed last time, if they fulfill their second mandate by buying MBS when others aren't, that will bring down interest rates.
That's right. That's you and I talked about in the first interview. Well,
Mhm.
so let's talk about timeframes. So, I assume the next big milestone now that essentially all the pieces are on the board is there's going to have to be an official, press conference, big, hubbub about make housing great again, wherever they're going to call it. That's probably going to be the name though. So once that happens, the announcement happens, Fannie and Freddie are coming out of conservatorship. Tell me the time frame. Give me like the over and under on it, what you expect to have happen. And I've seen a lot of people writing about this and talking about it, but Keith Jensen, you're the expert. Let's hear it.
So you stated two things. The two things are one, an announcement, and two, the actuality of it
Right.
occurring, which does or does not involve an IPO. Okay, so yes, it could be a Rose Garden announcement. It could be an executive order signed in the Oval Office, with the executive order would come an amendment to the preferred stock purchase agreement between the only two parties that actually need to sign off: Treasury on the one hand, Scott Bessent, our new Treasury Secretary, and FHFA on the other hand, our new director just confirmed, Bill Pulte. Those are the only two signatures required. Um, so the execution of a new letter amendment agreement is literally, it could be 2, 3, 4, 5 pages. That would be the recap and release. Now, the other half, the IPO. If it went at 2.1% right now, if it were 2%, because we're at 2.1% capital retention rate right now, as I already gave you that math, there's no IPO needed. If it was at 2.5%, Bill Ackman proposes to do an IPO first for Fannie and then one followed by Freddie. And if that order was adopted, so be it. And at present levels, that would be about a $27 billion IPO at the end of 2025. But the benefits would be immediately unlocked. And what are those benefits? The ability to utilize some or all of the value that is being monetized in favor of Treasury, and the ability of them to expand their agency held portfolio of MBS, and that buying power with their enormous balance sheet, of course, would cause the price of MBS to go up and mortgage interest rates to go down in proportion to how much buying they do. So now to give it one sentence, if the executive order was signed on Monday, these benefits could start working within weeks, even though the IPO might not occur for many months or even 10 months or a year.
That's fascinating. Okay, so that I didn't know as well. I figured that the benefits wouldn't happen until after essentially the official, IPO had happened. And so the IPO, this is going to be the IPO would be only necessary if again, using layman's terms, the savings necessary, the savings account, right? The slush fund, the piggy bank that Fannie Mae would have to have if that number wasn't lowered. Am I correct? Otherwise, if it is lowered, then the IPO isn't necessary because there's no real need to raise money. Do I
At 2,
understand that correctly?
at 2% capital retention rate today, no IPO is necessary. At
Okay.
2.5, one would be about $27 billion IPO. But they made $28.9 billion last year. So is it two large IPOs? Yes. Is it doable for companies that have averaged $27 billion a year in profit for the last 5 years? Very doable. Uh,
So
and
I'm
a
sorry.
portion of that is I think we touched on it last time. They're traded on the pink sheets, the OTC. Why? And what needs to happen, and what could be the first thing that happen? And this could even happen before the executive order is signed, or President Trump could put this as an executive order. And Bill Ackman discussed this also. Bill Ackman actually contacted some of the New York Stock Exchange and got them to agree that, unsurprisingly, these two of the most profitable companies ever, the two most profitable presently per employee, as we discussed last time, are clearly appropriate companies to be traded on the New York Stock Exchange and/or the NASDAQ. They were put on the OTC in 2010 in another one of the attempts then used to make them look less valuable. Because, of course, many pension funds all across the country and many funds all across the country and hedge funds have mandates which disallow ownership of stocks on the OTC. So when they're appropriately uplisted, that will increase the value of the stocks, obviously, and it will increase the value of the government's exercise warrants because they'll be exercising in to a greater stock value.
Okay, so you just said something that I know is really important, so I'm going to drill down on it. So one of the reasons, and Keith, don't worry about embarrassing me if I say something stupid, it's impossible. Because I will say something stupid. That part's possible, but me being embarrassed about it is impossible, just for the record. All right. Just for the record now, let's understand this. One of the reasons why the equity value of Fannie Mae in particular hasn't increased, three, four, tenfold, knowing that all this is kind of imminent. This, I think one would argue that it is because the institutional buyers can't buy because it has not been uplifted yet effectively, because they're like the BlackRocks, I'm only guessing here, are not permitted to buy things that are OTC. They're not permitted to buy pink sheet stocks. Am I somewhat correct about this?
There's scores of funds that have mandates to disallow ownership of OTC stocks. There's obviously, I can't speculate as to how many, but we believe that massive institutions like they used to pre-conservatorship will buy in mass these securities, and that indexes will pick up these securities like they did pre-conservatorship, many of them. And that, of course, will appropriately get them back to their pre-conservatorship valuations. And to give you an idea, their pre-conservatorship average price to earnings ratio was 13. Right now, it's less than 3.
So you're thinking again, let me say something dumb and correct me if I'm wrong, but you're saying hypothetically that the value of the equity of a share of Fannie Mae could go up by 10x?
I'm not going to discuss multiples here, but I am going to say that there's significant investor opportunity.
That's the reason you were such a successful attorney for 3 decades, Keith. Okay, well, I mean, so it does obviously create significant investment opportunity. And I think it does answer the question a lot of people have about if all this is kind of baked in, why hasn't the equity value gone up even more than what it already has? But people forget that Fannie Mae was trading for pennies, cents, less than $1, less than 50 cents not so long ago. And I think it closed at almost $7 just the other day. So go ahead.
People forget and they don't forget. They've long memories when they've been burned. And that's one of the reasons why, as discussed, the Treasury should write off and not convert its senior preferred shares. And another thing it should do is turn back on the dividends we discussed last time. There's 40 sets of junior preferred shares. There's only 2 commons, one common for Fannie and one common for Freddie. And of these 40 sets of junior preferred shares, roughly 20 for each of the 2 entities, a certain portion of them, when the dividends are reinstated for the first time in 16 years, will pay about 8.5% interest. And we all know that an 8.5% dividend on a systemically important financial institution is more valuable than a 4.5% T-bond.
Yeah. All right. So we're going to talk about that just because I want to understand it more. Hopefully the listeners are enjoying this as much as we are. All right. So as far as the senior or rather the junior preferreds that pay the dividends, if the dividend is turned back on, so I assume the dividend would be quote unquote turned back on after the release from conservatorship. Okay. Correct so far?
No, it could be done before, and,
Wow.
and really has to be done at the same as it's occurring. And here's why. They need to turn the dividends on as part and parcel of the recap and release, because each of the 40 sets of them have what's called a dividend stopper. It's also a transaction stopper. What does that mean? It means that the junior preferreds can't be crammed down. Why? Because each of the 40 sets of them needs to vote to a 2/3 majority of their holders in dollar value to be able to allow any of the other 39 sets to get paid a dividend or the common to get paid a dividend. It's very hard in a long-term process, let alone a short-term process, to get 40 different sets of shareholders to vote to 2/3 majority on anything. But that can be fixed with the flip of a switch by turning the dividends back on, which would cost the Treasury less than $3 billion a year, which in terms of the size of the transaction is a very small price to pay to, in another way here, get right with the market again, because many people do have a long memory of these stocks going to correctly,
Mm.
as you said, pennies in 2008 and going dropping about 65% in 2012 when the net worth sweep was instituted. And it's worthy of pointing out there's been two trials. One was a hung jury, and another one both in federal court in D.C. And I was at almost the entirety of one of them. And that second jury came back with a verdict, and it's effectively the only verdict about the entire 16-year conservatorship saga. And like the Supreme Court case, different issues there, it did not address the fundamental correctness of the conservatorship. It just addressed the whether it was correct or not, or whether it was a violation of shareholders' reasonable expectations to take all the money from two of the most profitable companies ever in perpetuity with nothing in exchange. And that's not something, those aren't my words. Those are words that the defense attorneys representing Fannie and Freddie did not quibble with. Those were the facts. Unsurprisingly, by the way, I've set up the jury question, which was answered in the affirmative, that it was a violation of the reasonable expectations of shareholders. Hence, the only final jury verdict we have on the propriety net worth sweep is that it was unreasonable and the government shouldn't have done it, and they overstepped, in effect, their authority in their relationship with the shareholders. That has yet to be entered as a final judgment. That final judgment can be used, as I stated, for different reasons, a way to wrap up the entire recap and release. But if you want to be simple, the jury has spoken and the government acted inappropriately in relation to the shareholders. And that is a final verdict pending entry of judgment by Judge Lamberth in Washington, D.C. federal court.
Awesome. So time frame wise, just to try to understand for folks that are just tuning into this, all this information for the first time, I'll tee you off. You're saying now that the junior preferreds could start paying dividends, whether it's released or not, which is interesting. But let's assume that you said on the Rose Garden or whatever, Trump has his. Go ahead.
Probably as a function of the recap release, but they could definitely turn dividends on a week before. They could turn them on Monday morning.
Okay, so Trump then announces, and I can just see this big, huge ceremony of all the people and the whole thing, and it's going to happen. This is my fantasy, right? It's going to happen in timing with this the spring housing market. Bill Pulte obviously is going to be somebody who is going to be, who could be better than him for helping Trump make housing great again through new construction, which is really obviously where it's going to go. We're short housing supply. What is it? 5 million. Some people said as much as 7 million homes that we need to have built. So that's going to create an enormous demand. The government has got a long track record of doing organized building after World War II and other times in history. The government has actually given builders huge incentives to, build massive subdivisions. I grew up in one. I grew up in a Sears home. It was delivered on the back of a train, and the returning soldiers from World War II built it on the lot that my parents eventually bought the house, decades later, but still, so this happened before. And I've read a lot, and I know you have too, about the fact that it looks to me like there's going to be some movement on different types of homes. It's now hard to get a Fannie Freddie loan on anything that's not stick built, in residential homes. So we're looking at modular homes. We're looking at all kinds of new experimental types of housing. So there's going to be a massive building boom. I can just imagine make housing great again. It's going to be something that Trump's going to, it's very on brand, let's say. So that happens. The thing is signed. You said the 5-page document is signed. Fast forward me. What's the next 12 months, 24 months look like? What are we expecting to happen next? And if you can tie that into feel free to do as much conjecture as you'd like.
A great question. I read today your excellent article, and your article correctly pointed out that JP Morgan just estimated the drop in interest rates to be 50 to 100 bips. We believe that's conservative. We believe it could be up to 150 bips. But let's go with JP Morgan's conservative estimate. That's what I think can happen in the 6-month to 1-year time frame as a function, as I pointed out before, of how quickly and forcefully the balance sheet of Fannie and Freddie is deployed to fulfill their second mandate. Buy MBS when no one else will. As pointed out, the Fed's not buying because of QT. As pointed out, banks are not buying because of their increased capital retention requirements. It's time for Fannie and Freddie to do what they're statutorily mandated and their charters require them to do. That. So and that buying activity is only unleashed, to use Bill Pulte's word, when the recapitalization occurs and when they have the authority to use their balance sheet to fulfill their mandate. And that, by JP Morgan's estimate, to not be redundant, will drop interest rates 50 to 100 bips, which is obviously huge for all creditworthy prospective home buyers.
And so, by the way, the article he's referencing is available on harrisrealestatedaily.com. So if you want to get our newsletter, you can subscribe. It's free. Just pop over there and put in your email address, and then you have to go to your normal email and confirm that you want the subscription. It's double opt-in, but it took me like 3 days to write that article on and off. So yes, it's waiting there. It's free. You'll get it the second you subscribe to harrisrealestatedaily.com, as well as all of our other daily podcasts and daily podcast notes. All right, go ahead.
And the other things that will occur is, of course, home building activity, and can happen in an explosive fashion, if you will, if and to the extent President Trump and Bill Pulte and Scott Bessent agree and intend to utilize that. We conservatively say at least $200 billion of monetized assets to build homes. So that I think it's about a 5 million, maybe $7 million, $7 million home housing shortage. So that can be addressed. And at the same time, you got interest rates coming down, houses being built, and potentially utilizing the dollars for other things like extending tax cuts, which is important to us, and or a partial payment on our government debt.
And you pointed out some really. Go ahead. Sorry.
I wanted to, I listened so I wouldn't be too repetitive to our last interview. And I brought up Jim Parrott in the context of bringing up Mark Zandi, but I didn't get a chance to talk about why I brought him up.
I was about to ask you about that very topic. You read my mind.
And I mentioned Jim Parrott, but I didn't have the opportunity to discuss why I brought him up. Here's why. In 2015, Mark Zandi and Jim Parrott co-wrote a piece without any support or analysis, and in that time frame, it was their view that a recap and release then would have increased mortgage interest rates. Well, 2015 was 3 years in the net worth sweep when Fannie and Freddie had zero equity capital. Why am I talking about a 10-year-old report, not a study? I'm talking about it because they were both advisors to the Kamala Harris campaign on housing, and they chose to expressly rely on their 2015 paper that took the view that of effectively then bankrupted companies, bankrupted by the government because they had zero net worth because it was all going to the Treasury. They relied on that study for saying that the same thing would be the case if they recapped and released today, that interest rates would go up. Josh Rosner wrote a great piece refuting that view. And what I didn't get a chance to discuss about Jim Parrott, we discussed about Mark Zandi, that he has interests because he's on the board of MGIC, the largest private mortgage insurer in America, to be opposed to the recap and release because, as we discussed, the private mortgage insurance industry is under an existential threat because the GSEs could write that insurance for so much cheaper. Well, we also have a view into Jim Parrott's views on the GSEs because he was an Obama housing administration advisor during the creation, and he was a principal architect of the net worth sweep. Jim Parrott was. And Jim Parrott wrote an email at that time that said, we've got to structure this net worth sweep, taking all their profits in perpetuity with nothing in return, with the DC federal jury found to be illegal, not an overuse of that term, because they found it to be wrong and in violation of shareholders' reasonable expectations. His email, Jim Parrott said, we need to structure this in a way so that GSEs can never purport to go pretend private again. It was a private email that was disclosed in litigation. It's been published by the New York Times. That gives a real window into Jim Parrott's thinking. Granted, in 2008, but there's never been, to my knowledge, a disclosure by Jim Parrott of who, if anyone, then or after he was no longer an Obama housing advisor, who, if anyone, he gets paid for or represents or consults for in relation to housing. And before Mark Zandi or Jim Parrott, who are certainly very knowledgeable on the topic, before they're allowed to express their views going forward, they should, in my view, come clean with who all of their who all of their interests are in relation to that might potentially pertain to a fair analysis of their views.
Well, this is potentially too much of a fun topic for us just to bounce off it in such an elegant way like you just expressed it. So hypothetically, what would have been their motivation? You're insinuating, you said this last time, that obviously Mark has a financial incentive, probably because he's associated with the largest PMI company, or one of the largest PMI companies. So that makes sense. Follow the money after all. But what else? What was I supposed to be reading between the lines where the money might be flowing, hypothetically?
So I'm not going to speculate on what I don't know. And I don't know who, if anyone, has been paying Jim Parrott for many years in relation to his consulting services regarding housing. But it just like people disclose what stocks they own on CNBC, and I disclose that I'm long Fannie and Freddie through my fund. People should be able to evaluate what people's potential biases are in relation to evaluating their views. That's my sole point. And as you correctly point out, Mark Zandi has an absolute economic interest in saying two things. In saying we believe with zero support and zero models that I've seen that interest rates would rise if they were recapped and released. And two, his view that there needs to be a legislative backing of them, which we discussed last time. And there's substantively zero difference between the present Treasury preferred stock purchase agreement, $250 billion backing, and a legislation law that said you have to back them to the tune of $250 billion. In other words, Treasury is no more likely to comply if you put it in a law. And will that backing likely continue by Treasury post recap release? Yes. And Bill Ackman speculates, and and models, it's not an unreasonable view, that they would be paid 25 bips a year. So what's that? That's about that'd be about $16 billion a year on an $8 trillion book of business. So Treasury would be if Bill Ackman's model comes out to be correct, and that's what Treasury and FHFA agree to pay Treasury for that backing going forward, Treasury benefits and profits from yet another way in relation to this that we discussed so many of the others previously.
So you and I have some friends, mutual friends, who are just spiritually opposed to invest in anything Fannie and Freddie because they're GSEs effectively. And would there need to be an explicit government backstop on Fannie and Freddie for these entities to be viable investments? Like if there wasn't an explicit guarantee from the government, what happens to their credit rating? We talked about that on the first podcast, but I'm wondering if you have any updated views on that.
No, they don't need a legislative guarantee. Two, Fitch, a ratings agency, has published a piece, and they've stated that they do not see any reason to change the credit ratings for Fannie and Freddie post recap and release, which really vanquishes the argument of those who have repeatedly said the opposite, that if they're recapped and released without a legislative backing, their credit ratings would go down and the interest rates would go up because MBS holders would demand more for them. Not according to one of the largest rating agencies who just said this about a month ago. Published it.
So when you turn on the news, and I'm just waiting for this political tsunami to hit when, again, the hypothetical make housing great again gets announced, you're going to see all these folks, they're going to come out and say interest rates are going to go up, cost to the borrowers are going to go up, and here's all these, reasons that you and I've just refuted, basically. What would be the motivation behind those types of folks? I mean, obvious ones being the ones that benefit financially from, PMI or whatever. But what would be what's the overarching
So,
motivation for folks to want these to stay in conservatorship? I don't understand.
eh, eh, so status quo might be people trading MBS, and status quo or a legislative backing, they get to mark up their book, right? If you're BlackRock or Vanguard and hold hundreds of billions of MBS,
Mm.
and now there's a law that says, as opposed to a preferred stock purchase agreement that says that they have to back them, call it to $250 billion, you get to mark up your book. Uh, that is an incentive. That said, Tim, we have no reason to believe that BlackRock or Vanguard opposes the recap and release. And we believe, because they say it, that the Mortgage Bankers Association believes and approves the recap and release. The National Association of Realtors does. The Independent Community Bankers Association of America. We effectively know of no institutional player that opposes the recap release. They all want it done safely and soundly, as we do, as Tim Howard does, as Jim Milstein does, as Bill Ackman does, as Bill Pulte does. That's not a reason to not do it and not do it now.
Well, all the players that were involved in putting into conservatorship back in the Obama administration, I don't know about Tim Geithner, but pretty much everybody else, Sheila Baird and all these others have all come out and said it should have been released a long time ago. So it is fascinating to watch this whole thing happen. And it's also fascinating from a layman's perspective, which, that's basically what I am on this. It's fascinating to watch the naysayers sort of all of a sudden stop talking crap so much about the release from conservatorship, and now they're all sort of editing their stories and now are seeing the rational. They're sort of like getting in tune with the fact that they're going to be released from conservatorship, and now they just better get on the train. It's just fascinating to watch this from a, I don't know, from a drama perspective, I suppose.
And I'm not going to share the names of the sell side analysts who are very conservative about GSEs, who have drastically changed their tunes in the recent months. But there's a number of them, and they have. And I also won't share what percent they're presently placing on the likelihood of a recap release, other than to say it's well north of 50%.
Yeah, I'm sure. So I've asked you this 3 or 4 times. You've avoided answering the question all 3 or 4 times. So I'm going to try a little bit more directly this time. So what is the best case scenario as far as timeframes go for all of this to roll out? Here it is. We're, March 15th. If
Well,
you were to not, if you could say something and no one's going to hold you to it, best case scenario timeframe wise.
So obviously, from the Oval Office's perspective, which is run like a triage, and obviously we've got war negotiations going on. We have budget negotiations going on. We have extension of tax deferrals that are being analyzed. That triage in mind, if you're going to limit the question to what's best for creditworthy home buyers, the economy, and the Treasury, the best time to do the recap and release and write off the Treasury senior preferred shares is now.
Absolutely. And what effect will this have on inflation? I'll answer my own questions. I just wrote about this. Is that if there's an essentially housing for many people, it is too expensive. It is too expensive because of the cost of housing, but it's really too expensive because of the interest rates and the loans. If the interest rates and if the essentially the monthly affordability of the houses were to drop, prices become secondarily important to the payments. But if you add to that an influx of new construction and new inventory, you're also going to see, obviously, not as we could argue inflation because of tariffs and all that. But we won't bring that in for the sake of this conversation. But there's no real reason to believe that housing will continue to inflate or appreciate at the rate that it's been if there's obviously a ton more housing that's coming online in the form of new construction. And anyone in the real estate industry knows that new construction, generally speaking, when compared to resale homes, is easier to sell and more desirable. The builders can throw all kinds of financial incentives on the houses, make the payments lower, all kinds of things. So if what we believe is going to happen, you are going to see an enormous amount of new construction, an enormous amount of new mortgage products, and that will make housing affordable again, because obviously there'll be a lot more mortgages. There'll be a lot more houses for folks to choose from. So the argument, which I suspect will be the third leg to the anti-release, stool, will be that it's going to drive housing prices up. And it just doesn't make sense that it would. There's that I can't think of a reason it would.
I'm not an expert on inflation or housing prices, so I'm not going to try to go there. I'm going to limit my analysis to what you've heard about interest rates. And obviously, you know far better than I exactly how much less expensive a 30-year mortgage is monthly with every tenth of a percent, let alone a percent, that mortgage interest rates come down. And I'm confident, for reasons stated, that mortgage interest rates will come down.
There you go. So anything else you'd like to say as we wrap up our second interview about this very interesting topic, very wonkish topic, but something that everyone in the real estate industry sure as heck better be aware of, because guys, with what we're talking about is going to be the fuel to the largest housing boom in a generation. A generation is 25 years, and it is our firm belief, and I wrote that paper, so make sure you download it from harrisrealestatedaily.com, that we are about to start a 25-year housing boom that's unprecedented, and I'll even be even more, demonstrative in my choice of words, in the history of humanity, because we're the demographics that all the reasons that we've talked about are going to create an enormous opportunity for people to own homes. And I think all of the arguments against owning homes, all the people that have tried to socialize housing, they've all fallen by the wayside. So get ready.
I will just leave you with this, and thank you for the setup, which is this. The 30-year fixed rate prepayable mortgage, as discussed slightly differently last time, is not only the greatest economic equality tool and product in the history of the world, it's the greatest creator of net worth for the vast majority of Americans who have a net worth. And its power will be unleashed by the recap release. So I would leave you with this simple statement. The recap release is in the best interest of all credit-worthy home buyers in America. It's in the best interest of the economy, and it's in the best interest of the Treasury, and it's in the best interest of President Trump, who gets to decide what of a number of wonderful things that I've gone over he gets to do with more than $200 billion.
Yeah, beautiful. All right, there you go, listeners. If you have any questions, make sure you message us, and do like and subscribe. I know this is a little bit slightly different from what we normally talk about in the podcast, but again, the reason that we're exposing you to all of this information is because it is critically important that you understand and you start preparing, because what's going to happen next in housing is going to be like nothing we've ever experienced before. So get ready, get your mindset ready. Get ready to take advantage of, essentially all this new information as we bring it to you first. I realize nobody in the industry is really talking about this other than Julie and I, certainly talking to real estate folks about this. And it's that important, because what's going to happen is if you're not paying attention, you're all of a sudden going to start missing the opportunity, because the train is at the station and people are getting on board. So please pay attention. Stay tuned in. Thank you for keeping this number one listened to daily podcast for real estate professionals. And Mr. Keith Jensen, thank you for joining me again today.
Thanks so much for having me, Tim. Have a great day.
You too.